This week, Learning Saturday, we are conducting two interesting webinars. The first one is Common Mistakes in Fixed Income Investing at 10 a.m. Also at 11 a.m., we have another webinar, the 1 crore journey, only for those serious about 1 crore. To join the two webinars, the link will be in the description. You can join using that.
Managing risk through allocation. Generally, we all want to take risks to create better returns. But we still cannot take as much risk as we wish. We have to take risk in alignment with our risk profile and our risk appetite. Most people don't even know whether they are actually doing this. We believe we are doing this. At a time like this, when we are headed into a phase of elections at the state and the center, it's important to know whether our portfolio's risk is aligned to our risk appetite and our profile. Are we in sync? If not, we should get it aligned. My sense is most people are actually traveling with a higher risk in their portfolio than what their appetite can take. So what is the next step? The next step is to reduce risk in your portfolio. How can you do this? You can take some money out of the riskiest part of your portfolio and keep it in cash. Then you can reallocate that money into other assets or within equity as an asset class, other segments where the risk is lower. So the choice is between alternate assets and non-risky or less risky part of the equity universe. But you need to make the choice now, you can't wait. So aligning portfolio risk to risk appetite and risk profile has to be done urgently on top priority, and probably if the market rises further on sentiment alone, and that rise is not totally backed by fundamentals, some more money can be taken away from the riskier parts of your overall portfolio and kept ready for any opportunity that may come your way. Even in products which we manage, where we think that we would take a certain level of portfolio risk, through our strategy itself as a portfolio manager, we are reducing the risk in the portfolio. We are not taking the same risk that we would take if the valuations are completely in our favor. The reason we are not taking those risks is because the valuations don't merit such an approach. So when the valuation comes down, we will gradually take more risks. So risks must be constantly altered in your portfolio and probably kept even lower than what your risk appetite can bear. The circumstances warrant such a thing. First, you would raise your portfolio risk to the level which your risk appetite can bear, or you would go closer to it. If valuations become very, very attractive, then you can position your portfolio risk even marginally higher than what your risk appetite can bear. But that can be done only under very extreme circumstances where valuations are completely in your favor. That must be done very, very rarely. It can't be done habitually. So this is a time when you reduce the risk in your portfolio to the level of your risk appetite, because I think it's now higher than your risk appetite, and you take it lower than that. If necessary, you take it further lower and keep it very, very modest until the markets correct to levels which you really like, where the valuations become more and more compelling. If you raise the portfolio risk when valuations are compelling, then the returns in your portfolio which you will achieve subsequently can be significantly higher. If you are not willing to do that and you don't have the patience to wait, then that will reflect in the portfolio returns that you will enjoy subsequently. And most importantly, remember that opportunities like this, where you can lower your portfolio risk, wait, and still get valuations which are more attractive and more rewarding, doesn't happen often. It happens only in an election year, when there is global crisis, when there is a lot of trouble in the macros of other countries when there is a war. So this is an extraordinary circumstance. It's not going to come again and again. You must use it effectively to move your portfolio risk to a safer place first and then to a stronger place next. That opportunity is before you, and I hope that you capitalize fully on that opportunity. Thank you for watching this video.